Year-end tax planning is something you don't want to get lost in the holiday rush. It's always a good idea to start getting your taxes in order at this time of year, said Lisa Green-Lewis, a CPA and tax expert for TurboTax. Here are a few tax planning and tax saving strategies to consider before December 31st to potentially help reduce your tax burden, or maybe even get you a larger refund in 2024. 1. Increase your 401k contributions. Several top tax planning strategies endure from year to year. These include increasing contributions you make to employer-sponsored retirement plans and other tax-deferred retirement accounts that are taken out of your paycheck before taxes, helping to potentially lower your taxable income today. While Roth 401k contributions don't decrease your taxable income today, once you reach retirement, the earnings can be withdrawn tax-free for qualified withdrawals. In addition, if your employer matches your contributions, increasing your 401k contributions to their match limit can help you avoid leaving free money on the table. For 2022, the maximum 401k salary contribution for an employee is $20,500 for those under 50 and $27,000 for those 50 and older, and $22,500 in 2023 or $30,000 for those 50 and older. If you're an employee who receives a W-2 form, you should generally make any 2022 contributions by December 31st. Other types of compensation may have different deadlines. 2. Roth IRA conversion considerations. With traditional individual retirement accounts, IRAs, contributions are typically made with tax-deductible dollars and can grow tax-deferred. However, withdrawals are usually fully taxable. With a Roth IRA, money is contributed with after-tax dollars, so you can take qualified distributions that are tax-free. In general, a qualified distribution is one made after you turn 59.5 or under certain exemptions, such as to buy a first home, or if you became disabled. Also, Roth contributions are subject to a 5-year holding period before the earnings on your contributions are considered qualified for tax-free distribution. The tax savings from an immediate reduction in taxable income should be compared to the alternative. Take a moment to calculate how much tax you'd pay on those funds versus the tax you may face on the gains when you withdraw the money in the future. You have until April 18, 2024, to make IRA contributions for 2023, but the sooner you get your money into the account, the sooner it can be invested. For the 2023 tax year, you can contribute a maximum of $6,000 to an IRA, plus an extra $1,000 if you're 50 or older. 3. Consider flexible spending account, FSA, funds. Make sure you're timely about submitting FSA expenses by the end of the year, unless your FSA allows you to roll funds to the next year. Check with your employer to verify. An FSA allows you to set aside pre-tax money to pay for qualified out-of-pocket healthcare costs. Typically, the funds are a use it or lose it proposition with a deadline of December 31st. Spending these funds doesn't directly lower your taxes, but remember, the purpose of the FSA is to provide tax savings when you contribute. If you don't spend the funds, you lose not only the tax benefit, but the funds set aside as well. FSAs can apply to a broad array of expenses, though the IRS can change what expenses qualify. 4. Consider tax loss harvesting and charitable contributions. Losses from selling stocks, bonds, or mutual funds can potentially be used to offset taxable capital gains, a practice known as tax loss harvesting. The size of the potential benefit from tax loss harvesting depends on your income level and the amount of your short and long-term capital gains, minus any current losses you may have already realized or any losses carried forward from other years. Also, if you make a charitable donation before December 31st, you may be able to write it off on your 2022 taxes. That means you can support causes you're passionate about and potentially trim your tax liability or realize a deduction. Charitable giving is one possible offset to the tax implications of a Roth conversion. Although a Roth conversion may increase your taxable income, charitable contributions can have the opposite effect if you can take the deduction. It may be possible to combine tax loss harvesting and charitable contributions. 5. Bunch your deductions. If your total itemized deductions don't exceed the standard deduction, consider bunching deductions, particularly in categories where you have to cross a minimum threshold. For example, you might decide to bunch your deductions on alternating years, meaning you take the standard deduction 1 year. Then, the next year, if you manage the timing of your purchases carefully, you'd likely surpass the standard deduction. You could also bunch charitable contributions by increasing donations in the years you plan to itemize and decreasing them in the years you plan to take the standard deduction. Year-end tax planning strategies for 2023. See the big picture. The end of the calendar year is an opportune time to pause and reflect, a mindset that applies to your taxes, household budget, retirement plans, and other financial items and goals. Is your house in order, and are you on track to meet your targets?